Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, chair of Property Investors Council of Australia and the 2014 and 2015 Property Investment Advisors of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I bring you the insider's guide to property finance and money management. Hello, Ben.
Now, you're saying each week, but at the moment, it's twice a week.
Twice a week.
No, so yes, happy to be here, Bryce.
Tuesdays, Thursdays, on the couch.
On demand.
On demand.
Whenever you want it.
Exactly.
24/7.
24 hours a day.
365. Fantastic. Now, who have we got in the summer series today, Bryce?
We have got a listener.
Great.
And I've met our listener, Jill Stewart, a couple of times.
Yep.
Most recently at the Sydney Property Buyers Expo late last year.
Yep.
And she is going to provide some insights into multiple properties, money management, what it's like to buy properties when you are on the land, you're a farmer. I think it's going to be a lot of gold here, so I'm looking forward to it.
Let's get straight to it, shall we?
Let's have a listen to what Jill has to say. Welcome to the couch, Jill.
Thank you very much. I'm honoured to be here.
We're honoured to have you. Hey, listen. First of all, how long have you been listening to the Property Couch, and how did you stumble across it?
I stumbled across it with the book, basically. I saw the book advertised in, it was Money Magazine or Your Investment Property Magazine, and bought the book, then realised there was the podcast that went with it. And I can't remember when I started listening, like which number. I've still got a few of them that I haven't listened to.
What?
But,
I'm only joking.
I know, it's terrible. But in saying that, I did upgrade my phone, and so I've listened to about 90 to 115 twice.
Ooh.
Because I wasn't sure if I'd listen to them or not, and so I've listened to them all again.
Right, yeah.
So, and I'm a bit of a podcaster addict, so I love listening to podcasts in the car or when I'm out doing anything, and the kids hate it because they have to listen to it too. But that's, love listening to the podcast every Thursday.
Oh, terrific. So,
And we need to find out, where are you at, Jill? Where's home for you? Just for our listeners to get an idea of where you live.
So I'm in Maureen, northern New South Wales.
Very
So
good.
we're about an hour from the Queensland border, west. So 5 hours is our closest coastline.
Beautiful.
now, I do know that you grew up in a place called Come By Chance.
I did, and back then it had a population of 8.
Right.
So
Wow.
so we lived on a farm, and that was our closest place, I guess, or point of reference. And so I was there till I was my parents were there till I was about 20, and then they sold up and moved away.
Now,
So that was my first job, was working at the Come By Chance phone exchange. Back in when we had, our phone number was 5, so you used to plug in the cords and the leads.
Fantastic. And the telegram wire. Now, I've got to ask the question. There's obviously history about that name. I mean, did they just come by chance water, or did they come by chance good field land, or what was the origins?
Absolutely no idea where it came
Jill.
from. But I can tell you that the people on one side of the street didn't talk to people on the other side of the
And
street.
there was 8 of you.
Because there was a cemetery on one side. So
Dead
one
centre of
street,
town.
cemetery.
Right.
Yeah, that's it.
Jill, take us back to what discussions were like for you around money when you were growing up.
It's quite funny. When I was a kid, and my parents were on a farm, so my mother was a teacher but was a stay-at-home mum back then, and my dad used to love investing in the stock market, and because he was a farmer, he followed the commodities and wheat prices, and back then, there was no internet. We had 2 TV channels, and so the news, he was home every day for the news no matter what, so he could see what was happening and read the papers, the Land magazine and whatever else every week. But we talked about it at the dinner table, so we knew if it was dry and wheat prices were up or down, how many bags an acre, how much money that equated to. And he talked about shares and investing, and I don't remember any specifics, but I always remember them talking about it and being quite open about it. And when I was 1 or 2, they bought a block of land at Stewart's Point, which is the different Stewart spelling, unfortunately, but which is between Kempsey and Maxville on the New South Wales coast. and they were doing the council, Kempsey Council was doing a village development, and so they bought a block there for $5,000 and they had to build on it within 5 years.
Mm-hmm.
So that was the start of their investment property for them to retire on. And so our holidays, every Christmas holiday or whenever we went away, we went to Stewart's Point, and Mum and Dad physically built this house, and house is probably being generous, by hand. And so that was our holidays. We worked to build something.
Okay.
And Jill, how good was your dad in the share market? Was he good at picking stocks? Was there anything that he focused in on, or was it just the fact that he maintained his consistency that allowed them to retire when they did?
Well, yes and no. And I mean, farming is very much you're up or you're down.
Yeah.
And so he would invest, and then when times got really tough, then he'd sell some off to pay the bills sort of thing. And then he would build back up. And so I guess the stock market investing was more of a safety net, as in you only invested bits and pieces, so you didn't invest to flip it and make a large profit. You invested in quality stocks, held on to them, and if you went broke, if something happened, then you always had access to that money.
The long game. Yep. Okay. So
exactly.
There was no speculation. There was none
whatsoever.
No. So your dad was a builder, a farmer, basically. He wanted to
farmer, not a hunter.
Yeah.
Exactly.
Love it.
Now, Jill, not a lot of people can say that they have a backstory. Well, that's a generalisation. Not quite often we don't hear of people talking about having open discussions about money at the dinner table, because quite often, we talked about it in a podcast earlier, a few episodes back, about how we want to actually open up the discussion for people to have these chats around the dinner table. But it sounds like it was something that was clearly evident in your household growing up. What sort of value do you place on that now, based on the money habits and the spending habits that you have now, based on having those open discussions early on, which may have been countercultural back then?
Well, I think it gives you, it opens your eyes, because I've got friends and they don't know anything about shares because it was never part of their family conversation, or their parents didn't have shares, so they don't have shares, so they don't understand what they're like.
Mm-hmm.
So it opened up by Dad having an investment property, or Mum and Dad having an investment property that wasn't bought for an investment, but it was always there. Investing in shares, we knew that these things were available, or that they were things that you could invest in, and so we would ask questions about it. And it just, I guess, you don't know what you don't know, and so just by talking about it, whether it be good or bad, I've invested in shares knowing that they could go up, they could go down. It's a long game. But I was able to invest in shares because I knew what they were. I understood how it all worked. And I think that's really, really important.
And that was before the days of online trading on shares, right? So did your dad have a broker, or did he have a financial planner, or?
No, I don't recall them ever having. Back then, a financial planner was the insurance agent that sold you life insurance or superannuation.
Yes.
Or your accountant. So they never had a financial planner per se.
Yep.
But Dad would read the paper and, I guess go with his gut and investigate and buy shares. So he wouldn't rely on his broker's recommendations. He contacted the broker and said, this is what I want to buy. And I would guess, and again, later life, he went with the Rivkin report and probably did a little bit more speculating, but he did that to speculate, not...
he wasn't risking the farm, so to speak.
No, nothing at all. And it might have been something that he was interested in so that he would get the annual report and be able to see exactly what they were doing.
Yeah, good point.
Do you think that was reflective of farmers at the time, Jill, or do you think your dad was a bit different?
I don't know. Probably a little bit different, because a lot of farmers, particularly back then, it was all about the farm. And I think now farmers have changed because you've got to watch the commodities markets nowadays. You almost need a business degree to be a farmer, because it's a little bit like property investing. It's all about the finance and, buying and selling and the futures exchange, things like that. you don't just grow your wheat or grow your cotton and sell it. It's about how you sell it and when and what the exchange rate's doing.
Yep.
So he was probably a little bit before his time in watching that, but nowadays farming's completely different to how it was 30 or 40 years ago.
So do you think that you're a beneficiary of that then, Jill? Because, in terms of success leaving clues, that was the conversation that you had over the dinner table. We had Paul Clitheroe recently on our 200th episode, and he talked about, for him, it was a discussion around the dinner table, where that led to him having this lifelong adventure and passion around finance. Because you have an above average size portfolio now. So do you think that's a success leaving clues there as to how you've sort of progressed?
Definitely, and I guess it's you have aspirations to do better, and so Dad and Mum, because Mum invests in shares as well, but they all wanted to have something else and do something more, and so I've followed along. But in saying that, my brother, who's only 18 months younger than me, sat at the same dinner table. He has no interest in investing, no interest in finance. He doesn't open his mail. He couldn't tell you what his mortgage interest rate is. Completely different, but yet we sat at the same dinner table.
Wow.
And I sometimes wonder why that, we listen to the same thing, but obviously you have different personalities, or I don't know, that you either love it or you don't.
Did he have any guarantee to take over the family farm, or was there any sort of security blanket that he felt that made him with that mindset?
I guess he was always the boy in, farming families, and it's the boy.
Yeah.
And he's younger. But Dad and Mum always said that they didn't want him to take over the farm, and they sold it and semi-retired. Mum continued teaching, but it was never an expectation for him to come back or that he was going to get given that. So it wasn't like he had this safety net that he didn't need to think about it. It was just... I guess it's just not his thing. He had no interest, and he still doesn't.
Now, you don't have to answer this question because I might be prying, and your brother doesn't have a right of reply here. But do you see that you're a little bit more financially secure than your brother?
Oh yeah, definitely. And just little things that, because he doesn't open his mail, if you literally, and I mean literally doesn't open his mail. If you get an electricity bill that's higher than what you've allocated for, and it direct debits out of your bank account, and then you don't have enough money, and everything goes bang 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 because you've bounced your other payments. He's not interested in. He doesn't care, and so. But if you don't care, then you are less financially stable.
Yeah. And living in city, living in bush, off the grid, what's sort of your brother? Is he sort of, how's he getting...
he lives in the same town. He lives in Moree as well.
Okay.
So, Mum and Dad, we moved here when I met my husband, and then Mum and Dad came and my brother moved over. They all got jobs and love the community.
Yeah.
So, no, I don't think it's any different whether you live rurally, in the middle of the city. It's just you're either interested in it or you're not.
So is he banking on the fact that Big Sis is going to be the insurance policy here, or...?
No, I guarantee you he's not, because he knows I'm too cranky.
I love it.
So, and he hates the fact that I tell him what to do all the time.
Maybe that's probably why he's...
I'm a younger brother with a big sister. I can relate to that. But, hey, tell us, Jill, what as much as you're prepared to share with us, obviously in terms of being as open as you can be. What does your portfolio look like now? What was your strategy? What was the first one like? Tell us a bit about the run up and what it looks like now.
So we always wanted to do investment properties, my husband and I, me more so than my husband. When we first got married and we saved and bought our first house that we lived in, when we were pregnant with child number 2, we upgraded, bought another house, and we said, right, we'll turn the first one into an investment property. No idea about investment properties, how it worked. I mean, we thought, how hard is it to collect the rent?
Yeah.
And so we managed it ourselves. And I've learned you never, ever rent out a house you've lived in, because it's just heartbreaking when they don't look after it like you did.
Yeah.
Mm-hmm.
And we had good tenants, but they didn't water the lawn, they didn't look after the house. It just went into disrepair, and we didn't realise that we could do, 3 monthly or 6 monthly inspections. As long as they paid the rent, we thought it was all good. And so after 2 years, I guess, when they moved out and we went and had a look, and it was just heartbreaking to see something that you'd loved because it was your first house, and we sold it. And so we basically said, no, we're not doing investment properties ever again. And we didn't. We sold our next house and moved into the one we're at now. And so we didn't even look at investments for another 10 years, just because we'd had such a bad experience. Whereas I think if I had put it with a property manager to start with, did some more research or spoke to people, then we would have made a better decision. And, who knows what we would have bought in that 10 years.
When are we talking, Jill? When was that first one that you moved out of?
1997.
Okay, thank you.
So, and then our next property that we bought after that was about 2009. As investment. We bought the house that we're in now in 2003.
Okay.
But yeah, so we thought, how hard is it? And now when I hear people, particularly on podcasts, and they talk about that they're self-managing, and I just think, it can be so much harder to do that, and you can have so many more, bad experiences that can really make a mess of it all.
Yeah.
Now, one thing I noticed here in the notes that we were able to get prior to having you on is you call yourself a spendthrift, but your husband, who you're happily married to, I'm sure, he was something slightly different to you. Is that sort of
interesting description you gave him?
I can't even remember what I gave him.
Tightwad.
I'm sure it was lovely. But when we first got married, he was the one that was really, really good with his money.
Yep.
And I was the one that would spend more. And, he would go through the phone bills and I would say, it doesn't matter. I guess we've evolved now, and particularly he calls me tight now, and so we've sort of swapped. But I look back and think about how much money that we could have saved, or the little things that we've wasted money on that could have made a big difference. And so now I think we're pretty much on the same page, although he reckons I'm the tightwad.
So what comes to mind when you do say those things that you could have saved some money on? What sort of jumps out in your mind?
Things like when we went on holidays and we'd take the kids to a crocodile farm or, Dream World or something like that, and you had to buy a T-shirt or you had to buy a cup or you had to buy a stuffed animal as a memento from it.
Yeah.
And they didn't care. That it was the memories that was most important, not the overpriced junk.
Wow.
Not the snow dome. I mean, you got to bring the snow dome. Yeah, I agree.
I mean, but that's a huge piece of wisdom we just heard there.
Yeah.
It's about the experience, not the collectibles.
Yeah, exactly. And then they come home and they get broken, or they collect dust and you throw them out when and so I just think if we'd have saved the little things that didn't really make any difference to our lives, it could have made a big difference later on.
So you've now moved down the path. What's the goal and what's the plan been for your investment activities? Because clearly you've got an above average portfolio in terms of numbers of property. And also, you're diversified into other things. What's the end game for you? What are you shooting for?
To be honest, my husband would like to semi-retire at 55, which is about 5.5 years away. And we've got kids at uni, and we've got kids, at boarding school and things like that. So I don't want to have to rely on the government. The government won't give me anything when we retire anyway. Mm-hmm. I don't want to have all my money tied up in superannuation and then somebody else controls when we get it or when we don't, that sort of thing. Mm-hmm. And so we've bought property with yield in mind more so than capital growth, because I don't ever want to have to sell them. Yep. I want to leave what property we've got for the kids, and then they can do what they want with it. So I guess we're basically looking at getting a property portfolio, but we still have shares and we still have a self-managed super fund and as well, so that sort of if one thing goes bad, you've got something else.
Yep.
But the end game is at 55 that we can be self-supporting, and that if I want to have steak for dinner, I can afford to buy whatever I want for dinner, and I can afford to put the air conditioning on or the heating on.
Sure.
And, you know, the stories that you hear, mum and dad's next door neighbour years ago would never put their air conditioner on because they couldn't afford the power bill.
Yeah, yeah.
And that's just not what I want for my retirement.
Have you defined what that looks like, Jill? Because it sounds like you want that freedom,
in a number
right?
form, no.
Okay.
No, and I think the number form changes and evolves depending on where you are and what you're doing.
Yeah.
So, I mean, you know, we've got the $2,000 a week that we all talk about.
Mm.
And I guess that's something that you're looking for.
Mm-hmm.
But
you haven't crunched those numbers.
No, and I guess that's my biggest problem is you don't know when you've achieved that goal, because I don't know what it is. And I know a lot of people start with an end goal in mind, but life changes and circumstances change. I mean, I've got 4 kids, so anything could happen with them. You know, they could need help. They could have an accident. There could be, you know, who knows? And so I think sometimes if you have an end goal, you might have an aim, but if you have a goal, it could shift. And so you need to be able to roll with the punches, go with the flow.
So I suppose what you're telling me is you're staying in the game. Your head's in the game. Whenever there's surplus cash, you're making sure that it's being allocated, from reading your bio notes here. But you're probably not lifting your eyes to what that could look like in 5 or 10 years, because you also talk about you've never focused in on what the valuations of the properties are, because that's not controllable yet. In a way, rent is controllable or cash flow is controllable. So I get it, but if I could give you a little bit of advice, and that is that even if you're in the game, it is helpful to sort of have some projection. As you say, goals can change, moments can happen into the future, but knowing the pathway that you're on, and sort of just being in the here and now and just looking after that, and then the future takes care of itself, I get. But it would be good for you to know that, because ultimately there's got to be a debt retirement strategy in there. There's got to be an exit strategy in there, and like your dad selling the farm and semi-retiring. That's all part of that story. What do you think about that?
Well, we have a debt. I don't like debt, and I'm a very cautious person. So whenever we look anything and make a decision, we've got an earth moving business, and so we buy machinery and we make decisions about what jobs we're doing and that sort of thing. So we always look at what's the best case scenario and then what's the worst case scenario, and we figure what's going to happen is somewhere in the middle.
Yep.
And we do the same thing with property, and we do the same thing with debt. So we've never done interest only, and I said this to Bryce when we were at the Property Buyer Expo, that I can't bring myself to do interest only. I understand the finances behind it, the reasons why, why financially it's a good decision, but I just can't look at the balance of my debt at the end of every month being exactly the same as it was last month.
We need people like you, because you pay for my roads. You pay for that gas barbecue in the park. And now I'm being facetious there, but the reality is you're leaving money on the table. But that's because you can't get over that line mentally around that mindset. Yep.
And we had one of the clients that we work for said to us, "You'll either pay interest or you'll pay tax," and that's true no matter where you are. If you're paying your interest, then you're not paying as much tax. But being self-employed, if we don't make money, we don't pay tax.
Yes.
And so that's a safety net. Whereas if we go and buy new machinery and it doesn't work for 6 months because we run out of work or it rains or whatever else, I've still got to make the repayments. Whereas if I own that piece of machinery, I'm only paying tax when I'm making money. And that's where we basically structured our investments and our business on the more that we can own, the safer it is for us.
Okay. Can I didn't think this would turn into an advisory piece here, but I think there's some of it. So you know that when you have an interest-only loan, that obviously the losses are at interest-only levels over a greater period of time, right? So, and I'm assuming you're doing your Part 4A variation, where you can get that money taken out of your tax. And I know you're self-employed, so it's a little bit different, but if you're paying wages to yourself, then ultimately you're going to be in a position where you can get that cash flow earlier rather than that tax return coming to you later on. Does that sort of make sense?
Yes. Yeah, no, it makes perfect sense, and we've looked at all that. We actually, it's funny, and I'm a believer that you've got to keep educating yourself.
Yep.
And we've been to several Spruker seminars, and, my husband, you go to the Gold Coast and you have those really pretty girls that grab your husband and, get him to sign up for something and things like that. And he says, oh, yeah, we'll go. And so we've been to so many seminars, it's just not funny.
Yeah.
So there's a separate discussion to have with your husband there, by the sound of it.
We've had that one last time. I said, you're not to talk to anyone, you're not to look at anyone, and we're not signing up for anything. So, but we went to a property seminar, and even though it was a spruiker and they were selling these off-the-plan houses and whatever, but that was when we learnt about the 4A and getting your tax changed fortnightly or with your pay.
Yeah.
We don't do that because we take drawings for the company as well as wages, so we get a tax bill, and I figure that just comes off it almost as prepaying your tax bill. But it's a matter of being, I think investing, no matter what you do, is being able to sleep at night.
Correct.
And so
every day of the week.
Yep, and for us, that's where it's at. Even if we pay a little bit more, if I can sleep at night, then I'm happy with that.
Sure, totally, because what we don't want to do is divest out of that. So you're saying you're willing to take that little bit of extra comfort over maybe a small financial gain, here and now, because it keeps you in the game. As opposed to...
And that's exactly right.
Yep.
And I've got a graph with our investment properties that I do on the last day of every month that tells me what the balance is of the loan, how much interest I've paid for the month on each property, and then the total. And I've actually now just broken it down to a daily interest that I'm paying on the investment properties, so that every month I can see that daily interest amount goes down.
Great.
Because I'm paying the principal off. And that keeps you motivated and seeing that you are moving forward. Even if that total debt is not moving a great deal, but you can see that you're reducing your interest and that you are going forward. And that, to me, so the value of the property going up doesn't matter because I know my debt's coming down.
Yeah, makes total sense. Quick one for you, Jill. Is it something, clearly you know your numbers, clearly you know your data within your own portfolio. Is your husband as equally invested in this as you, or is there a role thing going on here?
There's a role thing. He makes the money and I invest.
I was about to say, he's busy moving earth.
Yeah.
That's it. He has
but he could still be
interest
interested in the trajectory of it. But, I got the sense when I was chatting with Jill a couple of months ago that she knows this is her baby. Yeah. She's across it all. So that kind of
and
makes
your
sense.
husband was looking for the pretty girls at the other Expo boxes.
And that's exactly right. So, but he has no... This is my baby. Like I do the investing, the shares is me, and the property. But he's the one that goes to work every day and makes decisions with the business.
Yeah.
And that gives us the ability to pay ourselves and to buy property.
Now, Jill, in terms of, would you be uncomfortable with me saying that you've got more than 10 properties in your portfolio?
No, not at all. Not at all.
So, what would you? Because statistically, not many people get past 2 properties, Jill. So the fact that you've got more than 10, what would be some of the takeaways, given your experience, given you've been doing this since 97 and then investing again hardcore for the last sort of 8 years, what would you want the listener to know who wants to emulate what you're doing to make sure they didn't make, say, the same mistakes that you made, or they had a blind spot here or look around the corner? What would be some of those things?
I guess when we started investing, we didn't, it's just, and I think the internet has helped it so much because you can listen to podcasts now. There's so many more books that you can read now, that just doing the background research was really important. So our first investment property that we bought was, we actually bought half of Scott's mother's house because they couldn't sell it and they wanted to move closer to us. So we bought that in 2009 at Hervey Bay, peak of the mining boom. No idea that there was market cycles. Do you know what I mean? We saw it was a nice house. Yes, it'll make good rent. We had no idea of looking at the vacancy rates, no idea of seeing what the average rental was. It was, this is a great house in a great spot. Yes, we'll do that. Then after that, we bought a house locally in Moree, and we knew that we were going to get a good rental return for it. And I guess that was when we started to learn a little bit more. But I think about what I knew back then and compared to what I know now, and there's just no comparison. So I think that education and responsibility is the most important thing you can do. But I would rather make a mistake than do nothing. So
done is better than perfect, hey?
Yeah, most definitely. And even if you do you don't buy necessarily in the right area, as long as the numbers were okay and they were good to start with, they're still going to be good later. And you've got to be realistic. Buying a mining town, and I do have a house in Moranbah, but buying in a mining town like Moranbah at the peak of the market for 700,000 or 800,000 is just insanity. Because they're just, a lot of them just weren't even, looking at them at the coast, they wouldn't be worth that, let alone in a mining town. And those rents don't stay like they do forever.
So that's a good point, Jill. And so with your portfolio, given that you haven't really been chasing strong investment grade capital growth assets, you've been chasing balanced or yield assets. And again, it's the right story for you because it's the story you wanted to go on. Of those properties that you have bought, which ones have done the best capital growth for you?
I've bought 2 in Mackay in the last 18 months.
Yep.
And so Mackay was hit pretty hard, just like Gladstone was with the mining downturn.
Yep.
But I've bought 2 houses that are less than a kilometre from the beach on one side and 7 houses off the water on the other side. So they're sort of like on a peninsula.
Yep.
Ex-housing commission houses, so they're a very basic house. But I think they've and I paid $160 for one and about $195 for the other one. They're both returning $300 a week rent, and they've both jumped about $50,000 in the last 12 months.
So 18 months isn't a guide. Where I was probably leading with that question is, as you hold on to more and more of these properties, some are going to be better than others, right? That's just the nature of the game.
Yes.
And then when I was leading to is, with the ones that have grown in capital growth the best, how have they gone in terms of charging higher rents? Have you got any story or correlation there? Because the traditional sense is the better the capital growth, the more you can charge for the property as well.
Well, we had the first one at Mackay that I bought. We were looking about the $190, $200 a week rent, and that's gone up to $250 just in the last 6 months.
There we go.
And the second one that I bought, which is nearly exactly the same house, I'm getting $300 a week rent for that now because we've just had a new tenant go into it. Vacancy rates in Mackay are less than 1%, considering they were 12%, 2 or 3 years ago. But it's just the town turned, and you've got to look at the inherent values. Like it's on the coast. It's
the
there's
land
still
value,
a lot
the
of things
proximity.
other than mining and a lot of other industries that are there for the town.
I think the important point there is that what you're also observing is, if property prices are going up, there's obviously buyer demand. But secondly to that, if there's buyer demand, there's usually rental demand as well. Like people who want to buy in a good area, also there's renters that want to live in a good area as well, and you can get a premium for that.
Yeah, and I mean, that I look at some of the towns places that have been sold down. I'm a bit like Warren Buffett, about buying when others are fearful and greedy, and I think property can be like that as well. It's got to have inherent value.
Yep.
And so, particularly, Mackay and Gladstone that have been so oversold because people bought in at the wrong time and got greedy and overcommitted themselves. And that's where I think you've got to be honest when looking at property and looking at the numbers and think about worst case scenario. And so a lot of those places may have taken a hit, but they've still got a lot of good things going for them. So it's not necessarily, you've got to look at the actual place, not just
we talk about it being a lifestyle test. It's Mackay on the Whitsunday coast there, these are lifestyle areas, Harvey Bay lifestyle. So they pass the lifestyle test. Moranbah, no, doesn't pass the lifestyle test. It's just a...
And and because my husband started off working in the coal mines at Dysart, which is just near Moranbah. And so that's a spec investment. We bought it. It was a mortgagee sale. We bought it. We thought it'll go up and we'll sell it. So, it's just, and it's covering, it's positively geared now, covering itself. When it goes up in value, we'll sell it and not think twice about it because it's a spec and it's only there, it's positively geared so it doesn't hurt to hold it.
Yeah.
But we're not in love with it all. It's not going to be a forever house.
Yep.
Jill, you've been very generous with the information, what you're sharing. I think a lot of our listeners will benefit for that. The final one for me is, it sounds like the dinner table conversation with you as a child really benefited you. Has that flown through? You've got 4 kids. Were they privy to similar discussions, and what has that meant for them?
We did, and we've always tried to sit down, particularly when the kids were little, at the dinner table, and we talked about money and we talked about how they needed to get a job and work, and that if they didn't have a job then they couldn't eat because nobody gave them, Centrelink was never mentioned in our house, and so they grew up thinking if they didn't get a job they couldn't eat, like they'd just starve. And we've always talked about whether we were busy at work, if we've had a breakdown, how much it's going to cost. The share market went up, and so my kids are all really interested in that. 3 of them particularly. My oldest son's not so much, he's a little bit like my brother, but the other 3 kids are really focused, and so and all of the kids work hard. They'll think nothing to do 60 or 70 hours a week. And so my 2 youngest are at boarding school in Sydney, and they'll come home. David, I think he flew home and got off the plane at 9 o'clock in the morning and started work at 12 midday.
Yeah.
They're happy to work. They save 50% of their money. They know they invest. I save it and invest it in shares for them for later when they want to buy a house. They know that they're going to buy something, in the first few years of their working life. They know that there's money being, that they're saving money for that. And they want to do the same thing. They want to buy investment properties and be in control of what happens to their lives.
So if you're listening, Daniela, Jasmine, David, sorry that Mum plays this podcast in the car when you're around.
Yes.
But your mum and your dad are wonderful people, and they're obviously highly intelligent people because they know they've cracked the code. They know that basically life is about a bit of hard work, and also, basically planning for the future. So a bit of delayed gratification. And if you're listening, Joe, Mum's going to be on your back for a little bit longer.
Mum's already on his back.
In fact, Joe might be having to listen to this podcast.
Yes, and also to Scott, the husband, who's kind enough to allow Jill to come on the podcast and have a chat with us. That's all good news as well. Now, before we close out, I want to just give you the microphone, Jill, in terms of, is there anything else that you would like to share with the listeners, the community, in terms of, how some of your tips about what you might do if, you had your time over again, or if, for those people who are just starting out?
I would have educated myself more rather than thinking that property investing was easy. I wouldn't change anything from what I've done, but I would have learnt more. You have to take responsibility for your actions, whether they end up good or they end up bad. They're your actions, your responsibility, and you can't blame any. Once you put a pen to paper, that's your decision, and you have to take responsibility for that. So, and I guess don't just take somebody else's word for it. Investigate, make sure that you're comfortable in what you're doing. And, like I say, with the investment only, it doesn't work for us. We don't do that. But that's our decision. And if it works, something else works for somebody else, then that's all good. It's your own money and your own lifestyle that you've got to make it work.
Yeah.
That's fantastic advice. And if we had more time, we would also say that you organise your money well. You have your accounts set up. You distribute money into those accounts. So you're practicing the number one I suppose, solution to great money management, and that is organising your money. So, you know, we put it into virtual jars, you're putting it into certain accounts and so forth. So from that point of view, again, a big congratulations. As my phone's reminding me of a couple of appointments that I've got coming up.
Can I just say that I bought the book for myself and I've read it, and I have 10 copies, and that is what all my friends and family get for Christmas.
Oh,
Wow.
fabulous. Thank you very much.
We did not know that, so just for the record. But we appreciate you doing that. But hey, look, Jill, it's been great having you on. Thank you. I enjoyed the chat I had with you and your husband at the expo when I was talking to Ivis about this summer series. I thought you'd be perfect for it. So thanks for agreeing to come on. I think there's some real gold in what you had to say, and keep doing what you're doing. You're obviously on a really good path, and we look forward to you being able to do all the things that you want to do with you and your family. So well done.
No worries. Thank you very much. I've enjoyed it.
Wow. Isn't that an interesting scenario where two people from the same parents have two different life trajectories that are unexplainable?
Totally. And also that she's carving out a niche in regional. So she's just doing what she needs to do. She's focusing on a bit of yield. So, you know, different strokes for different folks. You don't have to do it all the same way as everyone else. So
it's interesting, you went into a little bit of advice mode, which was great, but then I remember having a chat with her, and she's very determined to have principal and interest loans, and that is the way that she wants to do it. But of course, we would tweak a little bit at the edges, but still, she's got the runs on the board. She is not a person who's talking about theory. She's doing it. And every time she's doing it, her confidence is growing, but she continues to take action, and that's what we love about people who take action in these uncertain times, because that's where the rewards are made. I love it. Jill, thanks for a couple of things. One, for opening up and sharing your story, and two, for coming on to the Property Couch with Ben and I to make sure that other people can maybe see themselves in your story and hopefully learn from the portfolio that you've built. But
and a shout out to the kids. I'm sure you're going to have to listen to this, kids. So hope we didn't spoil too much of your day.
Well said. But Ben, still plenty more gold to come in the summer series. So until the next episode,
knowledge is empowering, Bryce. Just pausing for effect. Pause. Maybe it's a bit of a holiday thing.
Is this an Ivis pause?
Yeah. But only if you act on it.
Only if you act on it. Wisdom. Love it. See you next week, folks. Want more great content from the Property Couch? If you haven't had a chance to go back to the foundational episodes, we got good news for you. Go to thepropertycouch.com.au/TPC20 and check out the free binge guide, which gives you the insights you need from the first 20 episodes, where we unpack the foundational pillars of the insider's guide to property, finance and money management. It's completely free and available now.